Hey guys, welcome back to another video. In this video, we are going to go over distribution schematics as the second part to our two-part video series on schematic. But just before we get into it, make sure to subscribe, give this video a like, follow me on Instagram, and join my free Discord server if you haven't already. Link is in the description below. So let's start off with a definition of what a distribution schematic is. So a distribution schematic occurs at the top of a trend or price leg, as its purpose is to send price lower. If you compare this definition with the definition of an accumulation schematic, you'll see it is the exact opposite. So now let's go over some theory. Again, this is a raw example, but let's start to annotate it and understand what is going on, just as we did with the other video about accumulation schematic. So firstly, what we can see is we have some equal highs over here. And remember, equal highs need to be formed first and then price needs to purge it. The second thing that needs to happen is we need to have a liquidity grab that grabs the liquidity from the equal highs or whatever type of liquidity that has been engineered to the left. Straight after the liquidity grab, as you know, there should be a very immediate break of structure. And in this case, it has to be a bearish break of structure as we have over here. So essentially, that is all we really need for a distribution schematic. So first, we need the formation of liquidity. Second, we need a liquidity grab. And then third, we need a bearish break of structure immediately after the liquidity grab. And generally, this movement over here is very impulsive. So how do we enter a position using a distribution schematic? This is very, very simple. All we have to do is we wait for price to pull back after the bearish break of structure to an order block left behind by the liquidity grab. And then we can take a short position like so, stops just above the order block, and we can target this low over here as a first target, but we can also get an extended target as we know that price should be sent lower from this point onwards. Taking trades like this, generally you'll have a small stop loss around 1 to 2 pips if you get in on the 1 to 3 minute time frame. It can also be said that these types of trades can be very rewarding in terms of risk to reward, as you are entering as soon as price looks to reverse at the top of a trend or at the bottom of a trend. So now let's go over a couple of examples where we can spot distributions in the market. So one example is this example over here. Here we can see we have a clear buildup of liquidity in terms of equal highs, and then we have this liquidity grab at this point. Next, we get the break of structure that is immediately after the liquidity grab, and then straight after this we get a return to the order block. So if we mark this out, we can see we would have entered the trade at this point here, allowing some base for spread, and then we would have been in a very nice trade. It plays out very well and price is sent lower. Another example, which is a bit more difficult to spot but is also valid, is this one over here. So this is more of a redistribution, and this is what happens when price is at a low already but wants to be sent lower. So first, we're looking for the buildup of liquidity, and we can see that in the form of these, I guess, mix between relative equals and trend line liquidity over here. And then we get the liquidity grab. After the liquidity grab, we get the break of structure from here to there, and then we get a return to the order block. So this would be our order block over here. It's not the best, but it's something we can use, and we can enter over here, stops just above, and we can see we get a nice trade out of it. In this example, or in this particular example, price returns to our area multiple times before getting sent lower. This example is a bit more difficult to spot, as I mentioned before, but it just goes to show if you know what you need to look for, you are able to spot distributions quite easily in the market. So as a summary of what to look for when looking for a distribution schematic, first you need a buildup of liquidity. Secondly, you need a purge of that liquidity in terms of a liquidity grab. And then immediately after liquidity grab, you need a bearish break of structure. Once those 3 points are fulfilled, you have the go ahead to take a short position with the expectation that price will be sent lower due to the distribution schematic. Thanks for watching this video. I hope you found it very useful. Make sure to subscribe, give this video a like, follow me on Instagram, and join my free Discord. Link is in the description below. See you in the next video.